Bear Market Watch 2019. We're still on it. We're still vigilant, waiting for the perma bears to say, I told you so. Is today the day? Is tomorrow the day? Is the day after that the day? Are the days today of the bear? Long story short, no, still not. But it's been over 2 weeks since I did the last market review video, so let's get back into it with the help of our favorite analyst from Macro Ops, Alex Barrow. And this is from his premium macro intelligence report. This is the good stuff. So first, let's just take a look at the labor market. Unemployment rate recently moved back below its 12-month moving average and is well below its 36-month moving average. See right here, it kind of jumped above for a second. That was a little warning sign, but now it's coming back down. I don't know if you guys can see that because I could barely see it. But what you don't want is this yellow line, the unemployment rate, heading above the 12-month moving average. And then you don't want this 12-month moving average moving above this 36-month moving average, because when you see that trend change, that's when you see the recession. That's that little gray highlighting that we got. See it happen here, happen back here. So this is probably one of the most important indicators we track at Macro Ops. But like I just said, the unemployment rate moved back below that 12-month moving average. We can look at other labor indicators like the Kansas City Fed Labor Markets Conditions Indicator. That's still an uptrend, meaning conditions for labor are good. The 4-week moving average of jobless claims, that's still trending lower. The Conference Board Employment Trends Index, still very positive on a nominal and year-over-year basis, going up. Good stuff, employment, great. So in summary, the labor market is strong and not yet showing any of the typical signs that precede a market top and a recession. Next thing we gotta look at is liquidity, which I still haven't made a video on. I'm sorry guys. I'm gonna do it. It's on my list. It's gonna get done. But subscribe if you want to see that liquidity video. It's actually very important, especially if you're following the stuff I'm saying in this video. You should definitely subscribe for that. So the St. Louis Financial Stress Index has reversed from its high levels last year. You can see it's trending down again. That's a good sign. Less stress, better for the market. And that's pretty much the same story you see in the Chicago Fed National Financial Conditions Index. God, that's a mouthful. That's healthy. The Kansas Fed Stress Index, that's good too. So overall, liquidity and financial conditions are easing and remain extremely loose. And that's especially true following the Fed's abrupt reversal of policy and forward guidance. And in that last yield curve inversion video, we kind of explained what Powell did, how he reversed course and what that means. If you haven't seen that video, I'll link to it above. So that reversal is very bullish for risk assets. High liquidity means that risk assets should keep going up. If there's ever a liquidity crunch, that's when things come crashing down. That's why it's important to pay attention to liquidity. And if we look at macro indicators, the Conference Board Leading Economic Index is positive on a nominal basis. The lei keeps rising. You get the recession when it's trending downwards. It's positive on a year-over-year basis too. And you'll normally see this indicator turn negative about 10 months before a recession happens. See, it comes a little earlier than the actual recession. But things are good. It's all green right now. And as we've explained in previous videos, stocks and bonds both compete for capital. So if the yield on bonds, like interest rates, are lower, that means less money is going to flood into them and more money will go into stocks instead. But you don't measure it straight with yield. Like you measure the rate of change of the yield. And as you can see right here, that yellow line, that's falling. So that's a good indicator for stocks rising. And it's actually at its lowest level now since 2016. And retail sales, which we were worried about because they collapsed in the beginning of the year, they actually rebounded right here. So Alex thinks that drop was likely the result of a negative wealth shock due to the end of the year market dislocation that we had. All that volatility, that huge drop, that's what caused a little less buying, possibly. So in summary, growth has certainly decelerated here in the US, but it's still far from levels that have signaled a coming recession in the past. This is why our base case is that we'll see a slowing growth and a muddling through until the global economy picks up in the latter half of the year. But now this macro analysis does not match with the sentiment. Or I mean, it doesn't match with what other investors are doing because they are still so bearish. If we look at the Ameritrade Retail Movement Index, it shows that retail traders have sat this rally out and their levels of positioning are similar to those that preceded the rally that began in early 2016. So we're seeing that same type of setup where investors are sitting out of the market because they're bearish when actually they should be bullish. So there's a lot of ammo and a lot of money that could come back in. Like this State Street Investor Confidence Index is at all-time lows. No confidence in our economy. Come on, guys. It's slow growth, but we're growing. Fund managers have their lowest allocation to stocks since mid-2016 still. Man, just wrong positioning. But good for us if we're bullish. Means there's more fuel for the bull. They had their highest cash balances since January of 2009. It's crazy how much they're not liking the market. There's a reason this is called the most hated bull market of all time. So in summary, sentiment and positioning still remain extremely offsides. This suggests that the path of least resistance remains up for stocks. Because what do we always say about sentiment? Bull markets don't die on pessimism, they die on euphoria. So if everybody's feeling bearish, that's good for the bull. And it's good for you and me as long as we're on the right side of the market, which should be the bullish side. And you can see how we've been running up. And I've been happy about it because the system I use has been benefiting, obviously, from stocks going higher. It's sat in our positions and it hasn't been shaken out. That's what I like to see. That's how you get the long-term gain. If you want to know more about that momentum system that I'm talking about, I'll link to that video up here. I explain it a little more. Now, if you like this video and you want to keep tracking this bull market and analyzing it and making sure it's not a bear market, then subscribe to this channel and hit that notification bell so you get an email notification when that next video comes out. We publish every single day, 7 days a week, about all sorts of business and market topics. Subscribe, hang out with us. It's so much fun. And I will see you in the next video. Stay fallible out there. Bye.